Fractional reserve banking. Fractional reserve banking is a system in which only a fraction of bank deposits are backed by actual cash on hand and available for withdrawal. This is done to theoretically expand the economy by freeing capital for lending. Today, most economies' financial systems use fractional reserve banking. Banks are required to keep on hand and available for withdrawal a certain amount of the cash that depositors give them. If someone deposits $100, the bank cannot lend out the entire amount. Nor are banks required to keep the entire amount on hand. Many central banks have historically required banks under their purview to keep 10% of the deposit, referred to as reserve. This requirement is set in the U.S. by the Federal Reserve and is one of the central bank's tools to implement monetary policy. Increasing the reserve requirement takes money out of the economy, while decreasing the reserve requirement puts money into the economy. Historically, the required reserve ratio on non-transaction accounts such as CD is 0, while the requirement on transaction deposit checking account is 10%. Following recent efforts to stimulate economic growth, however, the Fed has reduced the reserve requirements to 0 for transaction account as well. Fractional reserve requirements. Depository institutions must report their transaction accounts, time and saving deposit, vault cash, and other reservable obligations to the Fed either weekly or quarterly. Some banks are exempt from holding reserves, but all banks are paid a rate of interest on reserve called the interest rate on reserves, or the interest rate on excess reserve. This rate acts as an incentive for banks to keep excess reserve. Reserve requirements for banks under the Federal Reserve Act were set at 13%, 10%, and 7%, depending on what kind of bank in 1917. In the 1950s and 60s, the Fed had set the reserve ratio as high as 17.5% for certain banks, and it remained between 8% to 10% throughout much of the 1970s through the 2010. During this period, banks with less than $16.3 million in assets were not required to hold reserve. Banks with assets of less than $124.2 million but more than $16.3 million had to have 3% reserve, and those banks with more than $124.2 million in assets had the 10% reserve requirements. Beginning March 26, 2020, the 10% and 3% required reserve ratios against net transaction deposit was reduced to 0% for all banks, essentially removing the reserve requirements altogether. Prior to the introduction of the Fed in the early 20th century, the National Bank Act of 1863 imposed 25% reserve requirements for U.S. banks under its charge. Fractional reserve multiplier effect. Fractional reserve refers to the fraction of deposit held in reserve. For example, if a bank has $500 million in assets, it must hold $50 million or 10% in reserve. Analysts reference an equation referred to as the multiplier equation when estimating the impact of the reserve requirements on the economy as a whole. The equation provides an estimate for the amount of money created with the fractional reserve system and is calculated by multiplying the initial deposit by 1 divided by the reserve requirements. Using the example above, the calculation is $100 million multiplied by 1 divided by 10% or $5 billion. This is not how money is actually created, but only a way to represent the possible impact of the fractional reserve system on the money supply. As such, while it's useful for economics professor, it is generally regarded as an oversimplification by policymakers. Thank you.